Welcome back to StatPlus, where we bring you in-depth insights and updates on current affairs, emerging technologies, and market trends. Today, we delve into an intriguing economic paradox that is shaping India's financial landscape. Did you know that India's core inflation has reached an all-time low of 3.1%? This intriguing statistic belies a more complex economic reality that deserves our attention. In June 2024, India's overall consumer price index surged past the 5% mark, reaching 5.1%. This represents a significant increase from May's 4.8%, primarily driven by rising food prices. However, this headline figure masks a critical underlying trend: the stark divergence between core inflation and food inflation. This disparity underscores the complexity of the current inflationary environment and raises questions about the effectiveness of traditional policy responses. It necessitates a closer examination of the factors driving food inflation and a reevaluation of strategies to ensure overall price stability. Core inflation, which excludes volatile components like food and fuel, remains at a record low of 3.1%. This measure is crucial as it reflects broader inflationary pressures in the economy. Alongside core inflation, energy inflation has also declined, with fuel prices falling by 3.7% year-on-year in June, marking the 10th consecutive month of deflation in this category. The CPI can be broadly divided into three components: core, food, and energy inflation. With core and energy inflation well under control, it becomes clear that food inflation is the primary driver of India's current inflationary concerns. Food inflation surged to 9.4% in June, with vegetable inflation reaching a staggering 29.3%. Additionally, pulses inflation stood at 16.1%, while cereals inflation inched up to 8.8%, further contributing to the overall food price surge. This situation presents a unique challenge for the Reserve Bank of India. Despite low core inflation, the high overall CPI, driven by food prices, is preventing the central bank from reducing interest rates. The prolonged high interest rate environment is already causing signs of stress in the banking sector. However, conventional wisdom regarding interest rates and inflation may not apply uniformly to all sectors. Food demand is relatively inelastic, meaning it doesn't fluctuate significantly with changes in interest rates. People don't consume more food simply because prices are lower. Therefore, reducing interest rates might not lead to higher food demand and prices as one might expect. In fact, lower interest rates could potentially help cool food inflation through several mechanisms. Reduced capital costs for farmers could enable them to sell produce at more competitive prices. Increased disposable income might lead some consumers to opt for more expensive food alternatives, such as processed foods, reducing the concentration of demand in staples like potatoes, onions, tomatoes, rice, and wheat. This shift could have a deflationary effect on essential food prices. Lower rates could stimulate investment in agricultural infrastructure and technology, boosting productivity and supply. In conclusion, with core inflation at a historical low of 3.1% and fuel inflation in negative territory, food inflation emerges as the primary factor for elevated CPI levels. Counterintuitively, a reduction in interest rates could potentially help moderate food inflation, providing relief to millions of Indian households and supporting economic growth. Thank you for tuning in to StatPlus. If you found this analysis useful, don't forget to like, share, and subscribe to our channel. Stay ahead with our latest insights, stay informed, and we'll see you in our next episode.